A Treasury bond tango, China and the US. The intricate financial relationship between these two global giants has been a cornerstone of international economics for decades. For decades, China has been a major buyer of US Treasury bonds. This practice began in earnest in the early 2000s, as China's economy surged and its foreign exchange reserves ballooned. This relationship, where China essentially lends money to the US government, has benefited both countries. China, with its vast reserves, found a secure and liquid investment, while the US enjoyed low borrowing costs, fueling its economic growth. China found a safe and liquid investment for its massive foreign exchange reserves, primarily earned through booming exports. These exports, ranging from electronics to textiles, have made China the world's factory, generating immense wealth. The US, in turn, enjoyed low borrowing costs, fueling its own economic growth. This influx of capital allowed the US to finance its deficits and invest in infrastructure, technology, and other critical sectors. This arrangement, however, is no longer as straightforward. The global financial landscape is evolving, and with it, the dynamics of this relationship. Economic tensions, trade wars, and shifting geopolitical alliances have added layers of complexity. The global financial landscape is changing, and China, ever the pragmatic player, is adapting its strategy. Beijing is now looking to diversify its investments, reducing its reliance on US debt and exploring other avenues such as the Belt and Road Initiative. While the US remains a dominant economic force, China's diversification signals a shift in the global balance of power. This shift is evident in China's increasing investments in Europe, Africa, and other parts of Asia, as well as its push to internationalize the Yuan. This intricate dance of economics and geopolitics raises crucial questions about the future of global finance and the role of these two superpowers. As China and the US navigate this complex relationship, the world watches closely, aware that the outcomes will have far-reaching implications. Will this lead to a more fragmented or a more balanced financial order? The answer remains uncertain, but one thing is clear. The financial tango between China and the US will continue to shape the global economy for years to come. Cracks in the foundation. Why diversify? Several factors are driving China's move away from US Treasuries. The global financial landscape is shifting, and China is keenly aware of the need to adapt its strategies to these changes. One major concern is the sheer size of its holdings. With such a significant portion of its reserves tied up in US Treasuries, China faces considerable risk if the value of these assets were to decline. To manage this risk, China has been gradually reducing its exposure. This strategy is part of a broader effort to diversify its investments and ensure greater financial stability. Holding too much of one asset, even one as seemingly safe as US debt, can be risky. Diversification helps to spread risk across different types of investments, reducing the impact of any single asset's poor performance. The weaponization of the US dollar after the Russia-Ukraine war also rang alarm bells in Beijing. This event highlighted the potential for the US to use its financial dominance as a tool of geopolitical power. The freezing of Russian assets showed how financial systems could be used for geopolitical leverage, a risk China is keen to mitigate. By diversifying its holdings, China aims to reduce its vulnerability to such actions. Furthermore, the escalating US-China rivalry, evident in trade disputes and technological competition, adds another layer of complexity. The ongoing trade war and competition in technology sectors like semiconductors and artificial intelligence have strained relations between the two superpowers. China is wary of being overly reliant on its primary geopolitical competitor. Diversifying its investments is a strategic move to safeguard its economic interests and reduce dependency on the US financial system. By spreading its investments across different assets and regions, China aims to build a more resilient financial portfolio. This includes investing in infrastructure, technology, and other emerging markets, which can offer higher returns and lower correlation with US assets. Diversification is not just about managing risk, it's also about seizing new opportunities. As the global economy evolves, new markets and sectors emerge, offering potential for growth and innovation. By diversifying, China positions itself to take advantage of these opportunities while mitigating the risks associated with over-reliance on any single asset or market. In conclusion, diversification is a crucial strategy for managing risk and capitalizing on global economic trends. For China, moving away from US Treasuries is a calculated decision to ensure long-term financial stability and growth in an increasingly complex and interconnected world. Shifting sands China's new investment horizons. So, where is China directing its considerable financial weight? The answer, unsurprisingly, is multifaceted. Diversification is the name of the game, and China is playing it on multiple boards. One avenue is increasing its holdings of other countries' sovereign bonds. Japanese, German, and Australian bonds, for example, offer diversification and relatively good returns. Another strategy is investing in real assets like commodities and infrastructure. This approach secures access to vital resources and supports China's long-term economic goals. Gold's allure, a safe haven shimmer. Gold, the ultimate safe haven asset, has always held a certain allure. China, with its long history of valuing the precious metal, has been steadily increasing its gold reserves. This move is not just about diversifying away from the US dollar, it's also about securing a store of value in an uncertain world. Gold is seen as a hedge against inflation and geopolitical turmoil, both of which are becoming increasingly pertinent concerns. Section 5. Beyond the Yuan, building a currency bloc. China's ambitions extend beyond diversifying its own investments. It's actively promoting the use of its currency, the yuan, in international trade and finance. The establishment of the Cross-Border Interbank Payment System, or CIPS, China's alternative to the SWIFT system, is a testament to this ambition. By fostering a yuan-denominated financial ecosystem, China aims to reduce its reliance on the US dollar and exert greater influence in global finance. Section 6. The Belt and Road Infrastructure as Investment. China's Belt and Road Initiative, a massive infrastructure development project spanning continents, is another key piece of its diversification strategy. While often viewed through a geopolitical lens, the Belt and Road Initiative also serves as a significant investment outlet for China. By financing and building infrastructure projects in developing countries, China is securing access to new markets and resources. Section 7. Tremors in the global market. The global financial landscape is constantly evolving, and recent developments have sent ripples through markets worldwide. China's diversification from US Treasuries, while gradual and calculated, is not without potential consequences for the global economy. This strategic move by China is part of a broader effort to reduce its reliance on the US dollar and to strengthen its own currency, the yuan. A significant sell-off of US debt could lead to higher interest rates in the US, impacting everything from mortgages to corporate borrowing costs. Higher interest rates mean that borrowing becomes more expensive, which can slow down consumer spending and business investments. This, in turn, could dampen US economic growth and have ripple effects across the global economy. Slower growth in the US can lead to reduced demand for goods and services from other countries, potentially triggering a slowdown in global trade. Moreover, a shift away from the US dollar as the world's reserve currency could create more volatility in currency markets. Such a shift could lead to increased uncertainty and fluctuations in exchange rates, making international trade and investment more complex and risky. The global market is interconnected, and changes in one part of the world can have far-reaching effects, underscoring the importance of stability and cooperation in international finance. Section 8. The US dollar. Still a heavyweight champion? Despite China's moves, it's premature to proclaim the demise of the US dollar. The dollar's deep liquidity, the robust US financial system, and the lack of a viable alternative still make it the world's dominant reserve currency. However, China's diversification is a clear signal that the global financial order is evolving. The US dollar may remain a heavyweight, but it's no longer the only contender in the ring. Section 9. A New World Order of Finance. China's diversification from US Treasuries is a symptom of a larger trend, the transition from a unipolar to a multipolar world order. As China's economic might grows, so does its desire to reshape the global financial system. This transition will likely be gradual and not without its challenges. But one thing is clear: the world is moving towards a more complex and multipolar financial landscape, one where China will play an increasingly prominent role.